What is investment analysis? Well, investment analysis is a process that involves analyzing investment options to help investors evaluate investments based on their investment goals. This analysis focuses on understanding the value of an investment by evaluating factors such as market trends, industry trends, the company's financial health, profitability, future performance, and market value. Investment analysis can be conducted using top-down or bottom-up analysis and may involve financial analysis, capital investment analysis, investment analytics, and fundamental analysis. It's a broad term that helps investors make informed decisions about where to invest their portfolio based on analyzing stock prices, security price movements, and a company's financial soundness. Let's talk about the definition and importance of investment analysis. Investment analysis is a process that involves analyzing and evaluating investment options to help investors make informed decisions on where to invest their money. This type of analysis focuses on evaluating the value of an investment based on factors such as profitability, future performance, market trends, and the financial health of a company. Investment analysis involves conducting both bottom-up analysis and top-down analysis to determine the intrinsic value of a security or stock. This analysis can include financial analysis, cash flow analysis, and capital investment analysis. Ultimately, the goal of investment analysis is to help investors evaluate investments and build a portfolio based on their investment goals and the market value of different stocks. Now let's delve into the types of investment analysis methods. Investment analysis methods involve various approaches to evaluating the value and potential of different types of investments. When conducting an investment analysis, investors can choose from different methods, such as fundamental analysis, technical analysis, and portfolio analysis. Fundamental analysis focuses on understanding the value of a company by analyzing its financial statements, annual reports, and management competence to predict its future performance. On the other hand, technical analysis involves analyzing historical trading data to identify patterns and trends, which can help investors make informed decisions on whether to buy or sell a security. Portfolio analysis focuses on evaluating the overall performance of a collection of investments, such as individual stocks, mutual funds, or other assets. This type of analysis allows investors to assess how well their investment strategies are performing in different market conditions. Additionally, specific types of security analysis include evaluating a single investment or company through various metrics, such as trading signals or management competence. By using these methods, investors can gain an idea of the potential return on investment and assess whether the investment aligns with their portfolio management goals. Furthermore, a company may use different methods of investment analysis to determine the best course of action based on current market conditions. By combining different types of analysis, investors can make more informed decisions and optimize their investment strategies for maximum returns. Exploring the benefits of conducting investment analysis. Investment analysis is a crucial process used by investors to make informed investment decisions in the stock market. By understanding fundamental analysis, investors can gain an idea of the financial health and performance of companies in the industry. This involves examining metrics such as return on equity and internal rate of return to find the best companies to invest in. On the other hand, technical analysis focuses on patterns of stock prices and price movements, while security analysis focuses on individual stocks and bonds. Conducting investment analysis helps investors make sound decisions based on the idea of potential returns and risks involved. So how do I perform an investment analysis? Investment analysis is a crucial process for any investor looking to make informed decisions about where to put their money. One key aspect of investment analysis is fundamental analysis, which involves assessing the financial health and performance of a company or asset. This can include looking at things like revenue, earnings, and market share. Another aspect of investment analysis is understanding the patterns of price movements. By analyzing historical data and trends in the market, investors can gain insights into potential future performance. This can help investors make more strategic decisions about when to buy or sell assets. Understanding investment analysis is crucial for any investor's success in the financial markets. One common method used in conducting an investment analysis is fundamental analysis, which involves evaluating a company's financial statements, management team, and competitive position in the market. This helps investors determine the intrinsic value of a potential investment and whether it is undervalued or overvalued. Another important aspect of investment analysis is studying the patterns of price movements in the market. By analyzing historical data and trends, investors can make more informed decisions about when to buy or sell securities. It is important for investors to consider both qualitative and quantitative factors when conducting an investment analysis to develop a well-rounded understanding of the potential risks and rewards of a particular investment. Fundamental analysis involves evaluating the financial health and performance of a company by analyzing its income statement, balance sheet, and cash flow statement. This step helps investors determine the intrinsic value of a stock based on its earnings, assets, and liabilities. Technical analysis focuses on studying historical price charts and market trends to predict future price movements. This step involves looking at trading volumes, moving averages, and chart patterns to make informed investment decisions. Risk assessment is crucial in the investment analysis process. This step involves evaluating the potential risks associated with an investment, such as market volatility, regulatory changes, and economic downturns. By identifying and mitigating risks, investors can protect their capital and maximize returns. Portfolio optimization is the final step in the investment analysis process. This step involves diversifying investments across different asset classes to reduce risk and maximize returns. By carefully selecting a mix of stocks, bonds, and other securities, investors can create a well-balanced portfolio that aligns with their financial goals and risk tolerance. When it comes to analyzing financial markets, two popular methods that investors and traders use are technical analysis and fundamental analysis. Technical analysis involves studying past market data, primarily price and volume, to forecast future price movements. It focuses on charts and indicators to identify trends and patterns that may help predict where prices are heading. On the other hand, fundamental analysis looks at the financial health and performance of a company or asset. It involves examining factors such as earnings, revenue, and market conditions to determine the intrinsic value of an investment. While technical analysis relies on historical price data and market sentiment, fundamental analysis is more concerned with the underlying value of an asset. Proponents of technical analysis believe that all relevant information is already reflected in the price, making it unnecessary to analyze financial statements or economic indicators. On the contrary, supporters of fundamental analysis argue that understanding the fundamental factors driving an asset's value is essential to making informed investment decisions. Top-down and bottom-up are two contrasting approaches to investment analysis. The top-down method starts with an analysis of the overall economic environment, followed by specific sectors, industries, and finally individual companies. This approach is more macro-focused and looks at the big picture before drilling down to specific investments. On the other hand, the bottom-up approach starts with analyzing individual companies first, looking at their financial statements, management teams, and competitive advantages. This method is more micro-focused, emphasizing the fundamental qualities of individual companies rather than broader economic trends. Each approach has its advantages and disadvantages. Top-down may be better for identifying overarching market trends, while bottom-up may be better for finding undervalued individual stocks. Comparing valuation methods in investment analysis. When analyzing investments, there are several valuation methods that investors can use to determine the fair value of an asset. The most common valuation methods include discounted cash flow, DCF, comparable company analysis, CCA, and precedent transactions. Each method has its own set of advantages and disadvantages, making it important for investors to compare and contrast the results obtained from different methods. While DCF analysis takes into account the future cash flows generated by an asset, CCA looks at the valuation multiples of similar companies in the same industry. On the other hand, precedent transactions involve analyzing the sale prices of comparable businesses. By comparing the results obtained from these valuation methods, investors can get a better understanding of the fair value of an asset and make more informed investment decisions. In conclusion, comparing valuation methods in investment analysis allows investors to gain a comprehensive view of the fair value of an asset and make more informed investment decisions. Each method has its own strengths and weaknesses, so it is important to consider multiple methods to get a more accurate valuation. The role of an investment analyst is pivotal in the financial market, providing valuable insights and recommendations to investors. Their primary responsibility is to evaluate the performance of various investment options and help individuals or organizations make informed decisions about where to allocate their funds. Investment analysts analyze financial statements, market trends, and economic indicators to assess the potential risks and returns associated with different investments. They also conduct thorough research on specific companies, industries, or sectors to identify opportunities for growth or potential pitfalls. Based on their analysis, investment analysts prepare detailed reports and presentations to present their findings to clients or senior management. They must stay updated on market developments and continually refine their analytical skills to provide accurate and timely recommendations. As an investment analyst, one of the key responsibilities is to conduct thorough research on potential investments. This includes analyzing financial statements, market trends, and economic indicators to make informed recommendations. Another important aspect of the role is to stay up to date on industry news and developments that may impact investment decisions. Communication skills are also crucial, as investment analysts often need to present their findings and recommendations to clients or senior management. Risk management is another critical responsibility, as analysts must assess the potential risks associated with different investment opportunities and develop strategies to mitigate them. Overall, the role of an investment analyst requires a combination of analytical, research, communication, and risk management skills to make well-informed investment decisions on behalf of clients or organizations. Investment analysis is a critical aspect of the finance industry that requires a specific set of skills in order to succeed. One of the most important skills needed for success in investment analysis is critical thinking. Analysts must be able to evaluate data and information objectively, looking for patterns and trends that can inform their investment decisions. Additionally, financial modeling is another key skill for investment analysts. This involves creating complex financial models to predict future performance and assess the potential risks and rewards of an investment. Quantitative analysis is also crucial in this field, as analysts need to be able to work with numbers and data to make informed decisions. Lastly, strong communication skills are essential for investment analysts, as they must be able to effectively present their findings and recommendations to clients and colleagues. Overall, a successful investment analyst must possess a combination of critical thinking, financial modeling, quantitative analysis, and communication skills. When conducting an investment analysis, there are several factors that must be considered to make informed decisions. The rate of return, or ROI, is a crucial factor to evaluate the potential profitability of an investment. It's also important to assess the historical performance of similar investments and compare them to the current opportunity to gauge its potential success. Another important factor is the risk involved in the investment. Understanding the risks associated with an investment is essential in determining whether the potential return outweighs the potential loss. Additionally, it's important to consider the time horizon of the investment and whether it aligns with your financial goals and objectives. Finally, considering the impact of external factors such as economic conditions, industry trends, and regulatory changes can also provide valuable insights into the potential success of an investment. Financial statements analysis plays a crucial role in investment decisions. By examining a company's financial statements, investors can gain valuable insights into its profitability, financial health, and overall performance. This analysis involves studying the income statement, balance sheet, and cash flow statement to assess the company's past performance and potential future growth. With this information, investors can make informed decisions about whether to buy, hold, or sell their investments in a particular company. Key metrics such as profit margins, return on equity, and earnings per share can provide valuable information about a company's financial stability and growth prospects. Investors can also compare these metrics to industry benchmarks and historical data to evaluate a company's performance relative to its peers. Additionally, analyzing trends in financial statements over time can help investors identify potential red flags or opportunities for growth. Investors must also consider the quality of a company's financial reporting and the reliability of the data presented in its financial statements. This includes assessing the company's accounting practices, potential risks, and any discrepancies that may indicate manipulation or fraud. By conducting a thorough analysis of a company's financial statements, investors can make more informed decisions and mitigate potential risks associated with their investments. Assessing potential investment opportunities is a crucial step for any investor looking to make informed decisions. Conducting thorough research and analysis is essential in order to evaluate the risks and potential returns of a particular investment. Market conditions, industry trends, and the financial health of the company are all factors that should be carefully considered before making a decision. It is also important to assess the competitiveness of the market, as well as the potential for growth and profitability. Diversifying your investment portfolio is another key strategy to mitigate risk and maximize returns. By weighing all of these factors, investors can make informed decisions that align with their financial goals and risk tolerance. Ultimately, the goal of assessing potential investment opportunities is to make sound investments that have the potential to grow and provide a solid return on investment. Economic indicators play a critical role in investment analysis by providing essential information about the health of the economy. These indicators help investors make informed decisions by offering insights into factors such as inflation, interest rates, employment levels, and consumer spending. Understanding the current economic conditions is crucial for evaluating the potential risks and rewards of different investment opportunities. By tracking economic indicators, investors can anticipate market trends and adjust their investment strategies accordingly. For example, rising inflation rates may prompt investors to shift their assets into inflation-protected securities to preserve their purchasing power. In contrast, falling interest rates could encourage investors to consider bonds or other fixed-income investments. Therefore, staying informed about economic indicators is essential for making sound investment decisions. Economic indicators also serve as a valuable tool for assessing the overall stability and growth potential of specific industries or sectors within the economy. For instance, a positive GDP growth rate may indicate a robust economy and therefore present attractive investment opportunities in industries such as technology or consumer goods. Conversely, a decline in consumer confidence levels may signal potential challenges for sectors reliant on consumer spending, such as retail or hospitality. By analyzing economic indicators at both the macroeconomic and industry levels, investors can identify lucrative investment prospects and mitigate risks associated with volatile market conditions.